Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Fed Day, mortgage rates, and new home sales. Logan, welcome back to the podcast.
It is a pleasure to be here, Sarah. By the time this podcast comes out, it's Fed Day.
Fed Day. Okay, let's talk. What is Trump trying to do with the Fed? He's had all sorts of things. What do you think we're going to see tomorrow?
So there's an interesting discussion today of Nick Chamaris from the Wall Street Journal. Remember, Nick is the outlet of the Federal Reserve to the media, to the world, to stock traders. So Nick came out with a talking point about, in 2018 and 19, when Trump went into the trade war, tap dance, inflation was low. Inflation expectations was low, right? So it was a better backdrop. There was corporate tax cuts, and the Fed thought, well, if the trade war becomes inflationary, we'll try not to raise rates because that'll be a recessionary. And Nick made the point that it's difficult now because inflation has taken off. And if costs rise, people ask for more wages. So our thing for the last 2 years is labor over inflation. Wage growth has to go back down to 3%. For the Fed to feel comfortable. So for Nick to bring that out one day before the Fed meeting, it's kind of like a nudge, I think, that the Federal Reserve was like, hey, listen, you had this better backdrop back then. It might not be the best because of the memory of people asking for higher wages. So it goes back into my wage thing that they need to suppress the labor market and wages to make this work for them, where I don't agree with that premise, but that's kind of like the push. So it'll be interesting for the Q&As about all the questions they're going to ask about Trump, trade war, what's going to happen. Like we already saw a snippet of what we've talked about on November 7th, 2024. Trump declares 25% tariffs on Colombia, all these sanctions, everything. By the end of the day, it's over. We're going to get a lot of stuff like this. Even the watered down version of the tariffs. Now, instead of 25% universal tariffs, we're starting at 2.5%, and it's going to go up every single month. This is just how he operates, and it's going to be interesting to see the dynamic between the Fed, Trump, and what the market perceives this to be.
So one thing that I'm at the Mortgage Bankers Association IMB conference, been really great so far. One of the panels today, they were like, Trump could absolutely bring down rates as opposed to like going through the Federal Reserve. He could change the MIP, right, for FHA loans.
Okay, so this is another discussion that came out today that confused people because people thought that FHA was going away. There are people tweeting out because they think if the insurance goes away, FHA goes away. FHA, if you remove the insurance, which I don't know legally if that can be the case because of the 2012 FHA Solvency Act. So this is out of my wheelhouse, so I'm not sure. But I know that the FHA Solvency Act, which was passed by Congress, had some kind of mandates to it, that would, if you removes the FHA, that at least for that product, that goes down. It's not the conventional loans or the big bulk of loans out there. That is one way, but that has been discussed. Some people are confused by it because they think that FHA is going away. That's not true. It's just basically removing that insurance cost.
Okay, so you think tomorrow, no change?
No change, but forget about the no change. It's the Q&A about everything that's going on, especially when Fed Waller came out and said, maybe, hey, listen, we might cut, 4 times this year. I'd be curious, we're going to get a lot of Trump questions. I'll be more curious to see if Ebony brings up the rent inflation, because not only did the BLS rent index really fall, also the CoreLogic's single-family rent index fell. So the Q&A is going to be very interesting, not just for Trump's involvement in here, but also, because rates had gone up so much so fast, was Waller trying to talk the market down And is there a level to where the Fed just goes, okay, financial conditions are getting too tight? Because we go back to 2024 and what Fed President Lori Logan talked about from Dallas. She said, if the 10-year yield and mortgage rates go up, then we can be less restrictive because that is financial conditions getting tightened. So there's a lot of things in play for this Fed meeting, not just the relationship between Trump and the Federal Reserve.
Yeah, although that's the backdrop, right? That's the backdrop. Well, let's talk a little bit about the tariff. You said last time there was like a tariff tap dance. You talked about how the Colombia tariffs came and went in one day. That was exciting. Right now there is a deadline, I think, for Sunday, right, or Monday for Mexico and Canada and things like that. You think that's all just going to go away?
Treasury Secretary Bassett came in and it looks like they're going to do universal tariffs starting at 2.5% and then moving up. So remember the whole thing, don't fall for the big trade war thing. Everything's going to be tactical. This is a tactical move to try to get deals done. The whole let's just tariff everybody right away. Listen, this is the third year that we see this operation. We can't be surprised that he flips within 24 hours. So how the market responds is going to be a little bit more interesting now. So if there is going to be a universal tariffs and it's going to increase, then you're going to have to wait to see what kind of deals they want. And then we take it from there, which again, the only issue with that is that business investment about, what are we going to do? Is this going to create some, or the counter to that is that business doesn't believe he's going to go through with it and just operates as normal. Last time in 2018-19, business investment really fell and the stock market was down 20%. So it's one of these things that, if you're running the same playbook and everybody knows you are, how do they act this time? Do they just ignore it? Do they go forward? And that's, again, Republicans used to always say, how can business make any choices or plans if they don't know what the government rules are? So in this case, they're trying to water it down to give a little bit more breathing room for maybe leverage deals to go forward. That's kind of how my read was this week.
Let's talk a little bit about the stock market this week and what that means to the bond market and what that means for mortgage rates.
So, of course, Sunday, bond yields fell. The AI concerns that there was a $2 trillion of, market caps were wiped out, whatever. That's just everybody was crowded into the AI trade. So a lot of people just got out of that. So in traditional senses, the money goes into the bond market from the stocks as a flight for safety. Pricing was better, but not too great. We're talking on Tuesday, 10-year yields up maybe 1 or 2 basis points. There's no change. The compression of volatility and the spreads are acting really good when yields go up. Not as great when yields go down, but you could see there's a cap to how high rates can go unless the 10-year yield really takes off or we have some kind of event. That's just traditional money leaves stocks, goes into bonds, crowded trade. Everybody went for the safety first. Remember, when all hell breaks out, the U.S. bond market and the U.S. dollar, the only place people go to, really.
So let's talk a little bit about the tracker and how this relates to what you're looking at every single week.
So again, call. My home price forecast is a lot lower than everyone else's, especially Apollo. Apollo had like 10.8% home price growth. So what I'm seeing right now is what I like to see. New listings data is coming up. Right, we're showing year-over-year growth. We're going to get over 80,000, and remember, 80 to 110,000 is the norm between 2013 and 19. During the housing crash years, it's 250 to 400,000. So we're seeing a good positive trend so far on inventory. The pending contracts data is still weaker, higher than 2023, but slightly lower than 2024. So the elevated rates are impacting. It's been impacting the data for some time now. It's just now it's a little bit more clear. The growth rate was slowing down. Now it's slightly negative. Again, last year at this time, mortgage rates from 6.75 to 7.5 created 14 negative purchase application data, 2 positive, 2 flat. So far this year, we're 2-0 positive out there. We're early in the season. So it's just, for me, it's always keeping track of all this data and how the forward-looking data looks like in this. in this cycle. And it's just a little bit more unique because after home sales crashed, we're not going anywhere, right? Go up a little bit, go down a little bit. So we're hovering around here. So the firmness in the data that we saw toward the end of 2024 is very encouraging. And again, if mortgage rates go down to 6%, everyone's forecast is wrong. It's just we have enough data to be very confident about that now.
Well, and everyone's forecast is wrong in the best way possible.
Yes, the best way possible.
We will see more business. That's what it takes. That's what it takes for home builders. That's what it takes for everybody else.
And it's interesting because the new home sales report came out. New home sales beat estimates. New home sales are basically at 2019 levels. That would amount to 5 million roughly existing home sales right there. That's how you get near 6 million. That's what we did in the last decade. But builders, again, operates in a sub 6% mortgage market world when they need to. What was not encouraging about the new home sales report is that we're not going anywhere. And because we're not going anywhere in the new home sales report, the inventory is starting to build for them, completed units for everything. And this is why permits are at recession levels. So that was really and it was a good question people asking, well, new home sales beat, why aren't permits growing? They're not really going much. Those charts that we put, if you just look at them, ebbs and flows and just hovering, right? We're not much. We're above the lows of 2022, but we're not really growing sales enough to get the builders confident. But their completed units of sales now at 118,000. For them, that's a lot. Their total inventory is still moving higher. So they have a lot of, I think, 260,000 homes that are still in construction, right? They're going to be finished. And then they have 108,000 new homes that haven't even started digging dirt. That's the highest level ever. So you put that together. This is how I explain why housing permits are so low, right? At recession levels, the builders, they're just managing their backlog and what they have right now. So hopefully that makes sense, because a lot of people saw that headline report. They didn't know that the last 3 months were revised lower. And if you put it all together, there's not much happening, but supply is growing on, especially in the South. The South was such a big area for the builders to grow. And when you start getting active inventory in the existing home sales market grow, and then you're not pulling the trigger to be building a lot of homes. Like we wrote about in 2021, when rates rise, the march of dimes is not here. They're going to pull back to make sure they get their products sold.
Absolutely. Oh, let's talk a little bit about existing home sales. What do you see there?
Well, I mean, last week's existing home sales beat estimates, but that's a little bit old at this point. So I know back-to-back reports existing and new beat estimates, but to me, it's the forward-looking data that we started to see in summer, but really October, November, and December. Right now, by the time it's going to be a few months before our pending contracts data hits the sales data. So what we're seeing is we're not seeing the strength that we saw toward the end of 2024. Higher rates are doing their thing. It's slowing demand. Again, there's nothing crashing. There's nothing blowing up higher. But we have a rate range where things tend to slow down. And this is why we're going to take an eye on purchase application data again. That looks out 30 to 90 days. So we'll see if we have another positive week. We start stringing out more positive weeks for purchase application data, then eventually that hits the pending sales and the existing home sales report.
Here we are. It is the end of January, pretty much. Are we where you thought we would be as far as rates, as far as prices?
I am very happy about the inventory data. So, I mean, I think for some of us who did not believe in the mortgage rate lockdown, that inventory can never grow. It's again another positive sign. The rate stabilization is good in terms of whenever bond yields go higher, the spreads are acting really good now. So we would not have 8% mortgage rates in 2023 if the spreads were this good. But the Silicon Valley banking crisis ruined that whole thing. It just shows to me more and more that rates just get down towards 6. If it's sub 6% rates, a total game changer. But just getting down there, we can get the growth in sales. And again, we're working our way back to normal. Normal is a good thing. What happened in 2020, 2021, 2022, and in 2023, not good. You can't have too many people chasing too few homes. The pricing mechanisms don't work. now that we're working our way back up to normal, it's a healthier marketplace for the future of housing. Housing's going to be here for the next 100 years, right? You can't have just little short bursts of price inflation without consequences.
Logan, thank you so much for joining me today. I know we have short time today. We will talk to you again in a few days. Thank you so much.
Thank you.